And then I will press this start webinar now. So just give like a couple of minutes for people to just come in. So you can, like, we have accepted some attendees.
Oh,
so
yeah.
if you want to.
Are we live then?
We are live now.
Oh, right. Okay. Can we, yeah. Okay. Well, good afternoon, everyone. Andrea, can we see people on the?
So if you go to your speaker or gallery view, which is in the top right hand corner.
Gallery, oh, we're on gallery view. Hang on. Okay, so yeah, afternoon everyone. Sorry a bit, as you can probably work out, we're a bit new to doing these Zoom webinars, but we've done a couple so far. So just seen, I think we've got Prince, Anthony Lee, Ali Arshad, Wilfred on this call. So you're listening in. I think you hopefully just seen that Simon with us put on the chat if you've got any questions. I think we've had some from Prince who emailed them in previously. If you can just add those to the chat, then we'll deal with those as and when. So the idea is this a bit of a sort of discussion group, as it were, and bit of a Q&A session. I'm joined here by a team of us, Simon, Callum and Andrea, who alongside myself regularly advise on SEIS and EIS compliance related work, right from the advanced assurance applications that people submit at the outset, sometimes with our assistants, and then right through to all the ongoing compliance points and issues when you're raising money from early stage investors, angel investors who are making use of those tax reliefs, and then the post-round compliance obligations of the company too. So just a brief introduction to who we are. We've got Baron as well, who's joined us now. So yeah, we're a SRA regulated law firm. We do a lot of work with technology startups. We're quite new and sort of youngish and modern ourselves, and that we haven't been going very long, but we've grown sort of sevenfold in turnover from sort of next to nothing to where we are now in the last 2.5 years or so. And most of that growth is related to all the work we do for startups. And a lot of the work comes from our clients come from startups who sort of start right at the outset with their initial SEIS related investment round, which we might advise on the advanced assurance application, and then we get involved all other sort of legal areas that commonly come up for startups, particularly in respect of fundraising, and some of these, and as you might appreciate, some startups can raise a lot of money quite quickly and grow very quickly, and we've now the last few years been managed to keep ourselves and increase our own team alongside the growth of some of our firms and support them on their ongoing fundraising work. In particular, one startup who I think almost 3 years ago we assisted with their first SEIS and investment round. They recently raised their latest investment round was £10 million, and we've been through them over with every sort of subsequent investment round over the last 2-3 years, and they've been sort of almost continuously raising money with us, supporting with all the relevant legal documents and SEIS and EIS aspects. So yeah, I think we'll start off. I think you guys who got the invite, we've got who might have seen the overview of what this was about, we had a few sort of bullet points of what we're going to discuss. I think one of the main things that tends to come up is just understanding the advance assurance process at the outset, which is the sort of common starting point, which is very important for a company to get right at the outset. Some of these, some of them are much more straightforward than others. Others can involve quite sort of complex sort of grey areas around the law, and particularly when that's the case, it's important to get professional advice. You can, of course, apply for advanced assurance yourself online, and companies like Seed Legals have a way to make that process quite straightforward. I guess, you know, we can also do and often do the straightforward applications like Seed Legals, not quite as cost effective, but we can offer sort of a more hands-on service if you don't want to have to sort of go through and enter data yourself and answer questions, etc., in the way that they operate. But we tend to get involved in the more complex advanced assurance applications and EIS compliance issues. So anyway, so rather than me sort of talk any further, I think if Callum, you can give like a bit of a just brief overview of how the advanced assurance process works and what the main documents are that a startup needs, and the sort of main things to focus on when they're either applying themselves or they're working with an advisor or a firm such as us to do the application on their behalf.
Hi everyone, my name is Callum Ritchie. I'm a trainee solicitor here at the Jonathan Lee Network. As Jonathan has sort of touched upon, I sort of commonly deal with these sorts of applications almost on a weekly basis, and we encounter various issues. And broadly speaking, in terms of SEIS and EIS advanced assurance, if you're looking to instruct us, we'd always send out a detailed list of all the documents and information you need to supply to HMRC as part of the application. The main documents that HMRC are always looking for, one is the business plan, and as part of that business plan you'll need to input any sort of financial forecasts, usually for the first 3 to 5 years within that business plan. And you'll also need to lay out exactly how you intend to grow and develop the company. And in particular, you'll need to also have either incorporated into the business plan or as a standalone attachment, a spreadsheet type document detailing how you're going to spend the monies you intend to raise. So for example, if you're looking to raise 150,000 through SEIS, you'll have, I don't know, 100,000 that you'll be spending on hiring employees, 20,000 on rent, another 15,000 on marketing, and then you'll have an additional 5,000 left over for legal or accountancy fees. That's just an example, and it will just need to be laid out in intricate detail for HMRC to be able to figure out exactly what you're spending it on, and essentially making sure that you're spending it on all the correct areas in line with HMRC's rules. So yeah, I mean, they're trying to focus and knuckle down on the risk to capital condition, which essentially you're making two arguments. A, that you're growing and developing the company. That can be through obviously spending on marketing costs, spending money on hiring employees as you grow and develop the company, all those sorts of things. There's just two examples, and you need to make a sort of almost like a contradictory argument by saying that the investor's capital is at risk, and this can be through competition within a specific industry. Or if you're developing something really unique and innovative, then it will be highlighting that there's no market for this product or service. And it can be other external factors that are industry specific, but that'll all be covered under the business plan and also highlighted within the money you're intending to spend. In addition to those two documents, HMRC also require any accounts, the most recent set of annual accounts the companies have. Commonly, if you're a brand new startup, you won't have these accounts, so it's not something that you necessarily need to worry about. Another document that you'll need is the if you're going through an agent, i.e. going through a law firm, you'll need to supply us with an agent authorization letter. It's just something you'll need to sign and say you authorize such an agent to submit the application on your behalf and communicate with HMRC. Now, I do believe, bear with me 1 second. Sorry, 1 second, guys. I'm just getting up something.
I think another issue that commonly comes up is just the need to relatively recent thing that HMRC came up with a year or two ago is to you have an obligation to name investors, or which sometimes can be a little bit of a sticking point for startups. So you just have to make it very clear that to people that you might name on the application. I mean, in our experience, HMRC don't seem to be too fastidious about this, and just literally naming one, two, or sometimes one potential investor is fine for that requirement. And as far as the person you name, it's of no consequence if they then subsequently don't go on to invest. That's no requirement of them to complete the investment. So sometimes people can be a bit anxious, worried, concerned about being named because they think that's like a commitment on their behalf, but it's nothing that whoever then goes on to subscribe to the shares and whose names are then submitted to HMRC after the investment round completes is neither here nor there. They won't ever sort of check that against the names you submit with the advance assurance application. Sorry, yeah, Callum, were you going to say anything else?
Yeah, so just to add to what Jonathan said, a few other things that you'll need to supply HMRC with. One of them is the company's unique tax reference number, also otherwise known as corporation tax reference number. Sometimes when founders get in contact with us from the outset of a company not even being incorporated, we do have to go say to them that before we even submit an application, you will need to get a UTR in place first. So that's something that you'll need for any application. And we'll also need, for any application, you also need to supply HMRC with the latest copy of your Articles of Association. Often we find it's just the model articles, so we would just supply them with a copy of that. And I'm sure you can simply also state that the company just has the model articles of association for private limited companies. And if there's any agreements in place or with investors, or an investors wants an agreement to have advance assurance approval sort of stamped on it. For example, you might have a subscription agreement that you're looking to get investors to sign, or something similar to that. You'll have to send a copy of that to HMRC as well. More often than not, it will just be a subscription agreement, but sometimes it might be an investment agreement. An investment agreement is simply a subscription agreement and a shareholders agreement combined. More often than not, we find that the majority of clients we have don't have these agreements in place. By which, if you don't, it's of no consequence if you don't have these documents in place. You can simply just put relevant wording in any sort of application, saying that, oh, we don't have these documents in place, but we will be using SEIS and EIS compliance subscription to close the investment round within a cover letter that's produced. That's often wording that we use for any application, and it's always been acceptable to HMRC for any application we've done so far. And we also find that you'll need to provide a schedule of any sort of risk finance investments that you've received to date. That can be contained within the cover letter. It's usually on the application form itself. But for example, it can be if you've received any sort of SEIS investments before, and say you're looking to raise 2 million pursuant to EIS, you'll need to note down, oh, we've raised £150,000 2 years ago through SEIS. And if you've received any sort of state aid investments through government grants, so there's any assembly grants or something similar, that'll also be needed to note. That'll also need to be noted down as well. And you'll need to just note down, obviously, the dates, the amount, and the scheme of which you received those monies. It gives HMRC a sort of timeline with how much you've raised to date and how much you've sort of got left to raise under the EIS cap. So that is the schedule of investments. Another document as well, it's just a copy of the company's register of members. This can be something that you can put into the cover letter, or that's something that we always put into the cover letter when we send it to HMRC. You'll need to send a copy of the company's register of members to HMRC as well. But
Okay.
yeah, that's about it in terms of the documents.
We've got sorry, there's a bit of background noise, but I hope that's all right. But I think just to sort of go to Simon now, I think one of the main document that you have to supply is the business plan, which can be, as far as HMRC concerned, all they're looking for is something that just explains and details, gives them some understanding of what the business is and how it works, so that they can understand it meets the qualifying criteria. So therefore, what you submit to HMRC can be something very short and straightforward, like an executive summary of 2 or 3 pages. You don't have to put some great big long-winded business plan or a pitch deck that you might otherwise be using to attract investment. But it's important that sometimes there's some pitfalls about what you might put in there and what wording might be in this business plan. So I don't know if I just hand over to Simon just to give a bit of an overview of issues sometimes we see with statements that are in and information in the business plan document.
Yeah, sure. So, I mean, one of the common pitfalls that we've come across with business plans is them just being overly complex, or on the other side of the scale, you've also got situations where they're too simplistic. So, we've had pitch decks sent over to us that are 40 slides plus, which we find that normally the case is that the simpler the better. So the sweet spot is 12 to 14 slides for a pitch deck. And I think as a general rule of thumb, it should take you no longer than 10 minutes to sort of read through it if it's in a pitch deck format. But in the past, we've submitted high-level executive summaries to HMRC before, 3 to 5 pages in length, which just gives a sort of high-level overview of the company, its business, the team, and the market it's going to operate in, etc. So yeah, any pitch deck or business plan you submit as part of the application needs to be kept as simple as possible. In terms of things to avoid mentioning, a big thing is investor exits. So I think everyone's aware of the commercial reality of investing in startups, in HMRC are aware of this as well, is that the investors are investing with the intention that they will one day exit the company and make a capital gain on their investment. Everybody knows that, but it shouldn't be mentioned in the pitch deck that you submit to HMRC, because one of the qualifying criteria or rules is that there can't be any pre-arranged exits. So we just advise clients to make sure that the word exit or any sort of information relating to investor exits isn't included within the business plans. We've seen, I dealt recently with a situation where a company had submitted an application and they'd mentioned investor exits in their business plan, and that led HMRC to reject the application. So then they came to us asking if they could get a new application put forward. But so if that is in there, they will reject the application most likely. So that's something to avoid. Other things. Yeah, another thing that I've seen quite frequently is wording to the effect that the investment opportunity is risk-free, or that it carries very low risk. That's again something you don't want to mention, because as Callum mentioned earlier, one of the main criteria under the SEIS, EIS regimes is the risk to capital condition. So you have to explain how the company meets that condition, i.e. give compelling arguments as to why the investor's capital is significantly at risk. So then if the business plan contains information that says that this is it's a very low risk opportunity or risk-free opportunity, again, that's something you probably don't want to mention. So those are the two main things, I think. And yeah.
Cool. Yeah, so I think we were going to talk about yeah. So let's sort of presuppose that a company has we got, or the company itself, or whoever has got advanced assurance. Great, that's ticked off the list. It's got some early stage investors who are interested, who want to go ahead and subscribe and invest in the company and subscribe for shares. If I just hand over to Andrea, if she can just talk about the correct sort of procedure in terms of SEIS, EIS to sort of raise money and issue shares so investors can claim SEIS and EIS. So one of the sort of key points is that you have to have the money first before you can issue shares. You have to be careful on the dates that you present to HMRC, and also then just talk about the legal documentation that is usually used to close the investment round. So you know, it can be kept really simple, or it can be made more complex. A lot of that is driven by the investors. If you're doing early stage investment rounds, then hopefully you know, they don't have many requirements, if at all. So you just put together a straightforward subscription agreement. But there's also, you might also want to produce a shareholders agreement and or new articles. But anyway, if I just hand over to Andrea just to sort of discuss a bit more about that and the other legal documents that are involved before the investment round is closed as such, and the shares are issued.
Hi everyone. As Jonathan said, it's one of the pitfalls that we see with the clients is that they issue shares before receiving the money. So as Jonathan said, it's very important to already have the investment monies in place and then issue the shares. So to not create the thing that there is a debt. So basically you are issuing the shares for covering the debt. So this is one of the main important things. Again, as Jonathan said, the documentation can be very simple, a simple one-page description letters that explains exactly how the investment goes, or some of the clients they do a shareholders agreement to cover much more details. After you have lined up all the investors, you issue the shares, so make sure that you do all the company's house filings. So all the statements of capitals, they need to be filed very correctly, because when it comes to submitting a compliance statement, so that HMRC approve or give authority to the company to issue EIS or SEIS, EIS 3 certificates to the investors, they will fact check the company's house filings at the company's house. So make sure that everything is correctly filed and in time. After that, then it comes to the compliance statement, and if you already got advanced assurance, then it's enough to just attach the covering letter that you already explained to the HMRC how the company meets all the requirements, and then you direct the HMRC to see that you already issued the shares, you received the monies. Sometimes for SES, and especially if you have not traded for 4 months, because you will only be able to submit an EIS compliance statement if the company has traded for 4 months. If not, you need to show evidence that you spent at least 70% of the investment money. So one type of evidence is the bank statement. So again, it turns to that point that I mentioned already. You have to be careful that you receive the money before you issue the shares. If everything is all right, then you submit again with the covering letter all the documentation to HMRC, so they can give the company authority to issue the EIS, SEIS and EIS 3 certificates, so the investors can be able to claim tax reliefs. Yeah, I think like this is mostly the all the documentation in summary.
Another what we've seen happening a lot more regularly over the last year or so is the use of what's commonly called advanced subscription agreements rather than subscription agreements per se. This is where, pursuant to the advanced subscription agreement, which I think Seed Legal's called as a seed fast agreement or something, but yeah, it's one of the same things, but they use sort of different terminology, but the more usual legal terminology is advanced subscription agreement. So it's whereby investors put up money and hand over money to the company in advance of any shares being issued. So it's commonly on the basis that the valuation will be set and there'll be an investment round carried out in the future. When that happens, the shares will then be issued. And there are some sort of compliance issues around that with SEIS, EIS. So commonly, or used to be, a rule from HMRC that you had to then subsequently issue the shares within 12 months from the advanced subscription agreement being agreed. Being agreed means it's executed and the money's submitted to the company. So the date that the company receives the money. But that's recently, at the end of last year, that's been shortened to 6 months. So you have to be careful with that to ensure that you structure that advanced subscription agreement to take into account of that 6-month period, and it's clear to all parties that the shares have to be issued within 6 months now, as opposed to 12 months. We have been lucky on one occasion, anyway, persuading HMRC to allow a greater time period than 6 months, but that was after we got specific advance assurance relating to one investment round, whereby a lot of money was at stake, and they're getting HMRC to expressly say that in that instance, longer than 6 months was permissible. But that generally for most startups, early stage startups, you've got to have that 6 months in mind. It would be difficult to get around that with HMRC. So yeah, just if I hand over to Simon a bit, just to talk about sort of maybe sometimes in an instance where sometimes things haven't gone that well, and just thinking without naming names, sort of a couple of times where you've had to unpick things and companies' house filings have been done wrong and advance assurance wasn't received at the outset, and then you got involved where you then have to sort of unpick things and put together an EIS1 or SEIS1 compliance statement to HMRC with a whole load of supporting documents and having corrected filings at company's house. So yeah, without sort of naming names as such, but sort of give an overview of a couple of examples of where you've had to sort of dig people out of an otherwise a bit of a hole.
Yeah, so I think this addresses your question, Prince. You emailed it to us before, and you've also asked it in the chat whether it's possible to make these applications yourself without professional advice. Now, of course, we'd say that you shouldn't do that, and that you should use us. But we've had it we've advised in situations in the past where a company has submitted an application off their own back without any sort of guidance or support from professionals that are experienced in this area. And going back to the point that Andrea said about making sure the company's house filings are correct, I advised on a situation where advance assurance had been obtained, I think, at the outset, but then they'd gone on to raise the money, and the filings that they had made were a bit chaotic. So we were then involved to correct the company's house filings. We had to file backdated forms to correct the ones that were already filed and explain to HMRC the mess that had been made, and then submit an EIS1 compliance statement application on behalf of the client. And it took a long time, and it takes a lot of work to undo filings, because one of the unfortunately, if you misfile a document at Companies House, you can't get it removed easily. You have to go to court and seek a court order, etc. So, you know, one of the common pitfalls another common pitfall is not seeking professional advice on these things. I haven't advised on a single application, I don't think, where we haven't had to have some sort of input on the business plan or some supporting documentation that the client sent us. There's always something that shouldn't be in there, or information that's been overlooked, or something's not been included, and it's particularly where there are grey areas involving the qualifying criteria. It's advisable to get professional guidance, because the rules relating to SEIS and EIS aren't just contained within one neat guidance manual that you can just refer to and read everything from. It's dispersed among, I don't want to, maybe even hundreds of different segmented guidance manuals, and we've got a really good understanding of all of those, and you need to be aware of all these different rules in order to be able to make a successful application, even where you might think that the application is simple and straightforward. As I said, I've never advised on a situation where we haven't had to comment on the documents provided. So yeah, just I think, yeah, professional guidance is a must, really. And as I said, there's been a couple of instances that we've been involved, either where an advance assurance application has been rejected because they've not followed a proper process, or made incorrect filings, or confused HMRC with something they've said, or there was a film production application we dealt with, which are complicated enough as they are, but the company had submitted the application without any professional guidance, and HMRC came back with something close to 30 response questions, which involved us having to compile bundles of information and send them to HMRC. We did eventually end up securing advance assurance in all of these cases, but if you try and do these things, sometimes, I mean, you could get away with doing the advance assurance yourself, but then when it comes to actually raising the money, drafting the legal documentation, and getting investors to subscribe for the shares and hand over the money, you need legal guidance in that area. Yeah.
Another thing to add on this is another common pitfall that we can say when clients do applications by themselves, and they apply both for SEIS and EIS, and when they do the Companies House filings, they issue SEIS and EIS shares on the same day, which is not does not comply with the requirements. So it should be at least a day difference between issuing SEIS shares and then issue EIS shares. So when it comes to doing the compliance statement, then you need to address all these issues and definitely go back to the Companies House and do another filings and correct all the filings, so to make sure that the investors are able actually to claim their tax relief.
Yeah, I don't know. So we touched on subscription agreements, which is sort of the main legal document to kind of entice and regulate the actual investment of shares that you'll get the investor to sign, then exchange, and then they submit they pay the money usually to the company's bank account straight, rather than going through solicitors' client accounts, which sometimes you get for the larger investment rounds. But then quite often there's also a separate or agreement, a shareholders agreement, which relates to the ongoing relationship between the shareholders, including the investors. It's a constitutional document, which sometimes can be, as we sort of mentioned before earlier, can be integrated in one and the same document, which is called the subscription shareholders agreement, or often referred to instead as the investment agreement. But yeah, Callum, I don't know if you want to just highlight some of the main things that you commonly see in the shareholders agreement. I think it's normally there's things in the shareholders agreement that you put that for the benefit really of all shareholders, but then there are other times, particularly where you've been involved in other larger investment rounds, where the VC or the investor has requirements and like investor consent things that they'll want included, which sometimes with the really early stage things, the investors don't have any such requirements, but we might put a straightforward shareholders agreement together which doesn't include those things. But if you can just talk for a little bit about different types of shareholders agreements you see and what sort of requirements investors might have, or and if they don't have any, sort of what we put together instead.
So yeah, following from what Jonathan said, really whatever documentation you'd like, it does vary. Specifically with shareholders agreements, I tend to find more with the early stage startups, and if you're going towards more seeking investment at more your close network of family and friends, among other people. We often always insert drag along and tag along rights in the shareholders agreements. Now, if you're unfamiliar with what drag along and tag along rights are, drag along rights essentially enable those shareholders who hold more than 70, it can be whatever percentage of shares in the company, but predominantly usually it's 75% of the voting shares in the company. In the future, if ever there was a company sell, or there was someone looking to purchase their shares and other shareholders' shares that amount to 75% of the company's shares, those shareholders can then force the minority shareholders to have to essentially sell their shares on the same terms as themselves. While on the flip side, tag-along rights enable minority shareholders, in this case those investors, to be able to benefit from an offer for, say, more than 50% of the company's shares. That's usually something that we put in for the benefit of all parties, really. But certainly the investors would usually like to see tag-along rights inserted in the shareholders agreement. Two other things that we always put into shareholders agreements as well, we usually put into shareholders agreements, are preemption rights, and that's preemption rights on both the issue and the transfer of shares. Now, preemption rights essentially enables the current shareholders of the company. So in this case, if it was, say, one founder and 3 investors, and that founder wanted to raise more money and issue shares in doing so, they would have to first turn towards their current shareholder base, i.e. the 3 investors, or if, for example, an investor wanted to transfer a portion of their shares away and didn't want to be involved in the company anymore, they would first have to offer their shares, or the portion of the shares that they want to transfer, to the current shareholders of the company. And if no one wants those shares, or if no one's prepared to purchase those shares, then they can then usually go towards a third party. So those are the sort of main things we usually insert in shareholders agreements, or what we tend to find clients would like inserted in shareholders agreements for early stage startups. As the company tends to grow and you're looking towards more VC investment, or bringing on VC investors, we do tend to find that VC investors are looking for ultimately more protections, whether that be having a board observer, or a director appointed to the board. They might require certain investor protections, i.e. they'll have to have a say in certain decisions that the company makes. Those are all sorts of things that are relatively common things for VC investors to ask for, and subsequently any shareholders agreement you have will more than likely have to be updated at that point, or to the extent you don't have one, will have to be included in that shareholders agreement. We also find, specific to SEIS and EIS actually, that there is a number of VC investors out there that obviously wanting to protect their investment as much as possible, are looking for some sort of liquidation preference provisions in the sort of shareholders agreement or article. It's usually in the articles, and they would require that in place. Now, liquidation preference itself actually goes against HMRC's rules, but there's sort of a way around it, and it's something it's been phrased as liquidation priority, whereby say, for example, there's an exit event or something similar, at all stages, say for example the investor has A ordinary shares and everyone else has B ordinary shares, the investor and the other shareholders will share the proceeds, but it's usually done as a sort of waterfall provision, whereby say there's an investor amount that they're looking to get before anyone else. The proceeds will be split. They can be split up to 99.9%, and then the remaining 0.1% can be split between the other investors. And then once the VC investor gets the amount that they're looking for, the waterfall reverses. So say for example 99.9% of the remaining proceeds goes towards the other investors or the B ordinary shareholders, and then the 0.1% goes in the investors' pockets who have already received their investment amount back. And then once these investors have received their relevant amounts, it will then balance out and all the remaining proceeds are shared pro rata in accordance with the amount of the proportion of their shareholdings. Yeah, that's something that we've got quite a niche on in terms of applying for advanced assurance with HMRC, particularly in VC rounds, and it's certainly something that can sort of get around the fact that you can't have liquidation preference provision, or investors can't benefit from liquidation preference provisions, as it's seen to clash against the risk to capital condition. Now, like I said, that's more for the Articles Association, but it's certainly something that VC investors are more commonly asking for now. It's something, a trend that I've certainly seen more of over the years. Now, with respect to the shareholders agreement as well, we'd also include other stuff like, for example, electronic communication to make it a lot easier for parties to communicate, whether it's general meetings or something similar. And we would include that within the shareholders agreements to simply just it makes it easier for all parties. But yeah, I mean that's those are the more common things that we would include in the shareholders agreement at both the initial sort of seed round, pre-seed round, and then more commonly when the VC round comes into place.
Okay. Cool. Yeah, just I think sort of one other thing we're going to mention on the list, but I think sort of final thing just to mention, then we can, yeah, if any final questions you guys listening in want us to answer, please sort of message those in. But yeah, just one thing to keep things bear in mind is it's obviously not going to be right at the forefront of your mind if you're a very early stage startup, but you've got 7 years is the basic age condition within which you can continue to raise money pursuant to the EIS tax reliefs. So even when companies are raising funds from institutions, they continue to, in and amongst those investment rounds, to continue to raise money from high net worth individuals and EIS nominee funds for several years. So there's 7 years from when the company first starts trading, but there are a couple of exceptions to the basic age condition. So I think one is where the follow-on investment is anticipated from beforehand. So that's something to bear in mind as you approach that 7-year period, and also that the company is going to enter into a new geographic or a new product market that's completely distinct from their existing markets. Those applications can be really quite very time consuming and complex. Those are sort of take way more time and attention from us than sort of the standard basic tech startup ones with no issues. But yeah, and you have to make very kind of clear persuasive arguments to HMRC with reference to all their different guidelines, with different examples of what would be acceptable to them, what wouldn't, with sort of what they would constitute a new geographic and new product market. So, but as well as that exception to the 7-year basic age condition, there's something that's a bit newer that's come into place, which is called knowledge. HMRC calls certain startups knowledge intensive companies, and there's certain HMRC criteria which you need to fulfill to be a knowledge intensive company. And if you are a knowledge intensive company, then you have then EIS applies to the first 10 years. So I think I just Simon's done a bit with knowledge intensive companies, so maybe if you just say a final few words about things to bear in mind, and if you are a knowledge intensive company, then it's worthwhile making that application at the outset for advanced assurance as a knowledge intensive company, particularly as you can raise more money in one go. But I'll leave you to talk a bit about that.
Yeah, so if you're knowledge intensive, then you can raise more money over the company's lifetime. There's just different, you still have to meet all of the normal requirements for the EIS schemes, but there are additional qualifying criteria that you have to meet as well. So you have to meet either of the two conditions that I'm going to mention in a second. So one is the innovation condition. So this means that the company must be carrying out work to create intellectual property, and it must expect that the majority of the company's business will be generated from that IP within 10 years. Or, so it's not an and, it's an or, so it's just one of the innovation condition or the skilled employee condition. So the skilled employee condition is that the company must have 20% of its employees carrying out or working on research and development. And these employees must have a relevant master's or higher degree. So yeah, I mean, these applications, you have to submit to HMRC more information than you otherwise would, because there's those additional qualifying criteria that you have to meet. But you can raise more money. So a knowledge intensive company can raise 20 million over its lifetime, whereas for a non-knowledge intensive company, it's 12 million. And so there are benefits to doing it that way. So if you think that you would meet those requirements, then your best bet is to make the application pursuant to both SEIS upfront, but make the application as a knowledge intensive company. We've got experience with getting these applications through. They do take a little bit more time, but it is definitely doable. You just, again, if you're applying down that route, then you definitely need to seek professional guidance, because the rules relating to knowledge intensive companies are quite complex, and there's a lot of hoops that you have to jump through in order to satisfy HMRC that you qualify as knowledge intensive.
Cool. Okie doke. So yeah, I don't think those sort of questions coming through this time. We've had Prince ask a few questions, but hopefully I'm looking at the right stream here. But yeah, I think we've somebody mentioned, was it Baron, that there's a recording, so we can send a recording of this to anyone if they're interested. I think it will go on the website as well, but generally I think we'll have your email addresses as well from this, so we can follow up that way as well. Yeah, I mean, feel free to keep in touch, and if anything, any of you would like to instruct us on advanced assurance or whatever else it might be, or you just have a one-off query that hopefully we can answer just quickly maybe without us being instructed, then feel free to always use the We Will Help email address on our website. So if you go to our homepage, jonathanlee.net, top right hand corner by the phone number, there's the We Will Help email address. It's always sort of the best way to initially engage us and set out everything that what the background is and what you're looking for clarity, or what help you're looking for, and then someone can engage from there. One of the team can email you back, or you can set an intro call if needed. We always offer, if you're interested in instructing us on anything, we always offer a no cost, no obligation 20-minute call to work out what the issues are, and after that we can produce a suggested scope of work and quote in writing. As I mentioned earlier on the chat, we have sort of fixed fees for certain defined things we do, like advanced assurance, and in most cases we try and stick to a fixed fee of 1,000 plus VAT to advise on produce and submit an advanced assurance, SEIS and EIS advanced assurance application on behalf of companies. Of course, you can do that cheaper on Seed Legals, effectively using that platform yourself, or which other way you may do it. But in the current sort of marketplace that sort of represents good value, and you get all the additional sort of insight and experience from us as we sort of assist you in putting together that application, and then discussing, you know, how to go on to then raise investment, the legal documents to use, and giving guidance around that area. And then we're there to assist on an ongoing basis as hopefully the company continues to raise money and legal and tax issues around that, as well as all the other legal areas that a startup may have on an ongoing basis. Yeah, and I think one thing to bear in mind is our success rate. I think I think last year we did in excess of 70 advanced SEIS EIS advanced assurance applications, and I think the only ones that have ever failed have been one relating to a film production company where where we told the client that it would fail in the first place, but they still wanted us to make the application, and also a Chinese-backed company that couldn't satisfy the risk to capital condition because it already had like a massive contract in place, and HMRC were just never going to give advanced assurance because that's sort of not what SEIS EIS is in place for, because they didn't really need to raise money from angel investors. So that's sort of like the risk to capital condition where that sort of comes into play, and to have that in mind, and be careful how you put the information to HMRC. So basically I would say we've got like 100% success rate, albeit there's been a couple of instances where things haven't gone through, but largely that's you know, where we told clients, look, this isn't going to go through anyway, even though despite our best efforts, this isn't going to be an SEIS EIS qualifying activity or meet the criteria for HMRC. But yeah, we're confident we see all the common issues, and we're happy to guarantee our fees as well when we do the advanced assurance applications.
Just to butt in, Jonathan, we've actually got a 100% success rate this year so far. So out of all the applications we've done so far this year, where we've got a response from HMRC, thus far it's been an approval.
Yeah.
So yeah, I think we've done around 50 to 60 applications this year. Can't give an exact figure, but every single one's come back success.
Yeah, and those tend to be the more complex ones. So it's quite nice sometimes when we get really difficult ones that we put covering letters of pages and pages together, and we think we still have some doubt that maybe HMRC will come back with further questions, or you know, they're not going to like that. But we've so far managed to get them all through, and particularly where we've got referrals from companies that have used like a more established big accountancy firm or law firm who have sort of messed things up, and then they've come to us, and we've managed to then do a much better job and get things through and approved, and then that company can go on to raise money and be successful, hopefully. So anyway, we better go, but yeah, thanks everyone for your time, and I hope this was relatively insightful and useful, and you can take away some sort of key points from this. But yeah, be great to keep in touch, and hopefully we can assist you or anyone you know in the future. Cool.
See you later, everyone.
Thanks, guys.
Thank you, everyone. Thank you.